5 massive things up front. First, the very best way to avoid paying crypto taxes is to hodl or hold on for dear life. In my opinion, this is the very best strategy given the risk-reward profile of Bitcoin in the coming years. Second, long and short-term capital gains tax rates do apply to crypto, so wherever possible, try to hold your crypto investments for longer than 12 months because the capital gains tax rate will be lower after you hit that 12-month holding mark. Third, the reality of crypto taxes is a lot more complicated if you plan on becoming a trader or someone that uses crypto as a medium of exchange regularly. So if that is you, look into a program like CoinTracker. Basically, it's a software that will connect to whatever exchange you use and it will track everything automatically for you. But for the rest of us who are just looking to buy crypto and hold for the long term, you should not need any fancy software. Fourth, transferring from one exchange to another in the United States is considered a taxable event. So sending crypto from something like Coinbase to Gemini is taxable. Some good news, however, is that any losses you incur in crypto throughout the year are actually deductible, meaning they can offset your capital gains elsewhere. And shortly, we will get into the transactions that will trigger a taxable event, but just know that the IRS treats crypto like a property. So anything like collectible coins or vintage cars, very similar property tax rules will apply to Bitcoin and all crypto. And starting in 2019, the IRS is now asking every taxpayer if they have had any crypto transactions during that tax year. So the main examples of taxable crypto transactions are 1. Selling crypto for cash or realizing the gain on your crypto property. 2. Using crypto to pay for goods or services. An example would be using Bitcoin to buy a pizza. Don't do this. 3. Converting one crypto to another is considered a disposition, aka a taxable event. So converting Bitcoin to Ethereum is a taxable event, and yes, even if you don't cash out your crypto for fiat currency, the US dollar in this case, this is still taxable. 4th, receiving mined crypto. 5th, being paid in crypto, shout out Russell Okung, or receiving crypto via airdrop. If you're paid in crypto by an employer, it is classified as compensation and will be taxed according to your income bracket. 6th, receiving crypto rewards, things like staking and earning program rewards. More on these topics later. If, however, you receive crypto as a gift, you will not have a taxable event until you sell the crypto. These transactions must be reported at their fair market value as measured in US dollars. So if you bought a pizza with Bitcoin, you would have a disposition of the Bitcoin equal to the cost of the pizza. Next up, here are some common events that are generally not taxable. 1. Buying crypto with fiat currency or dollars. There's no gain or loss recognized if you just hold it. 2. Donating crypto to a tax-exempt organization. Check out givecrypto.org for more information. 3. Gifting crypto to someone. If you give a large gift, yes, it may trigger a gift tax, but this will depend on your specific situation. That said, you can gift up to $15,000 worth of crypto per recipient per year without paying taxes. Any amount above this per year would most likely require you to file a gift tax return. 4. Transferring crypto from one wallet that you own to another wallet that you own. Of course, check the records on the exchange that you use to confirm these are not recorded as a disposition. And 5th, transferring between Coinbase accounts like Coinbase to Coinbase Pro, which is their trading platform. Transferring from an external wallet to a Coinbase account is also not taxable. But let's look at a hypothetical example using easy numbers. John buys one Bitcoin for $1,000. This is not a taxable event. John is then given a gift of one ETH that's worth $100 at the time, and the person giving it acquired it when it was worth $50, which is their cost basis. This is not taxable. Then 2020 happens and John's Bitcoin takes off to the moon in price, but he doesn't do anything with it. No taxable events just yet. Later, John sells 0.1 Bitcoin for 4 ETH. Don't worry about the math here, just know that a crypto to crypto conversion is taxable in the US. John then transfers crypto to his hardware wallet, which is a non-taxable event. Then Bitcoin forks, generating a new coin, which is treated as income and is indeed a taxable event. A fork is just a change in the software of a digital currency that creates two separate versions of the blockchain with a shared history, creating a new digital currency. Receiving free crypto like this is taxed as ordinary income valued at the fair market value on the day it was received. If, however, the fork crypto is sitting on an exchange but you can't transfer, sell, or exchange it yet, it's not yet taxable. But don't worry, we'll cover these topics and many others in much more detail in future episodes, so be sure to subscribe. And lastly, in our example, John sells 0.9 Bitcoin and 4 ETH, resulting in a taxable event in which he realizes a capital gain of $8,100. Once again, don't worry about the math for now. Just remember, CoinTracker and other software can do all of this math for you and break things into short-term and long-term capital gains, ordinary income, and they'll complete your tax forms for you automatically. And real quick, the forms to know are Form 8949, which records transactions qualifying as a capital gain or loss. Form 1040 or Schedule D is the summary of your capital gains, and then Form 1099 miscellaneous is used to report rewards or income from staking. Staking crypto is just a way to earn crypto rewards for offering your crypto to validate transactions, or put more simply, it's locking your crypto for a time just to receive rewards. Once again, more detail on future episodes. But now, what you've been waiting for, how to outsmart the system legally. First, harvest your losses at the end of each year. If you're down a few $1,000s on any crypto throughout the year, you can just sell that crypto and use those losses to reduce your capital gains elsewhere, and then you can just buy that same crypto right back. So for example, if I held XRP and was down $5,000 on December 31st, I could sell my holdings for fiat and reduce my tax liability by $5,000 and then just buy the XRP again if I was still bullish on the crypto moving forward. Yes, you will pay transaction fees, but you'll most likely still come out ahead. 2, I would track everything. As mentioned, if you're going to be an active trader and using crypto as a medium of exchange, look into CoinTracker and the crypto trader platforms. Thank me later. 3 would be to hodl, hold on for dear life. I cannot emphasize this enough. Most of us should not trade crypto. If you want to, that's great, and I support you fully. But as you'll learn in future episodes, I strongly believe Bitcoin is going to change the world, and the risk-reward profile of Bitcoin is literally unlike anything I've ever seen. I have been in finance for about 10 years, which isn't anything crazy, but it's long enough to know a thing or two. Now, if you're a big shot in dealing with big money, there are tax-friendly countries where if you can maintain residence for 6 months or more during the year, certain places like Germany, Portugal, Thailand, Singapore, and others may offer you huge benefits. 5th, some places are now allowing you to buy crypto in a sheltered or a tax-advantaged account like a 401k or an IRA. There aren't a ton of options yet, but more and more are coming onto the scene, and one of the best ones out there is itrustcapital.com. This is an excellent idea, and as a former financial advisor, one that I would strongly recommend if you decide you want to hold crypto for the long term, which you probably should. So listen to this. If you contribute a few $1,000s each year into Bitcoin in a Roth IRA, and it grows to $1 billion in 2040, you would literally owe $0 in capital gains as long as you don't take out your funds before you're 59.5 years old. And lastly, depending on where you live, you may be able to set up a company and reinvest profits without paying taxes. You can check out Zolo if you want to go the professional route of avoiding taxes. And yes, there are certainly other loopholes and a plethora of illegal options, which I would not advise. But if you can find a younger, sharp CPA with experience in Bitcoin, they can show you some other tips and tricks like the loss harvesting that would be unique to your situation. All right, guys, that's going to wrap it up for this episode. Please take a moment to like the video if you did and consider subscribing for more Bitcoin and crypto content. But with that, I look forward to seeing you in the next video. I hope that you have a great day.